Welcome to the Spokesman Speaks, a podcast for farmers and ag professionals by the Iowa Farm Bureau, bringing you the news, experts, and educational insights that matter most. Now, here's your host.
Welcome to our November 1st edition of the Spokesman Speaks podcast. I'm Andrew Wheeler, and today's episode includes tips to help you best manage your farm's income taxes this year. 2021 was another unusual year with income from COVID relief payments and various other unique circumstances. We've got an expert here to walk you through it, Kristine Tidgren, who's the director of the Center for Agricultural Law and Taxation at Iowa State University. Spokesman writer Corey Munson takes it from here.
We're here with Kristine Tidgren, director of Iowa State University Center for Agricultural Law and Taxation, to talk about tax issues that farmers should be aware of as they prepare for the 2021 returns. Kristine, thank you so much for joining us today.
Well, thanks for having me.
So before we get into specific tax situations that we want to talk about, are there any general income tax recommendations that you have for farmers? Any best practices that you'd recommend that to make sure that farmers are getting started off on the right foot?
Well, I always just say that it's really important to make sure that you have your books and records in order by the end of the year, before the end of the year, because it's really important that you have an idea on what your income level is going to look like. We collect all those records throughout the year. Hopefully, they're being recorded in a good system. But that's a really important tool for you to be able to make important decisions on what you're going to do before the year end that may impact your tax liability. And gather your receipts and do all that cleanup that's sometimes hard to do, but it's very important.
Absolutely. So when we're talking about 2021 specifically, what are some key tax issues that farmers need to be aware of as they finish out the year and get ready to file those taxes?
Well, it's been an interesting year. We've had some unusual payments that have come in still in 2021, flowing from some of the COVID relief, but we've also had prices that have gone up. And so that means higher prices for some crops, but it also means higher prices for some of our inputs. And so it's in some cases going to mean that farmers have higher incomes perhaps than they expected, or maybe not. It's going to all depend on your individual situation. And so you really need to look at what your income level is like here coming up on year end, because a lot of times you'll make decisions such as perhaps prepaying on some of those input costs for next year. And that might give you a good opportunity to get a discount as those prices are very high right now. But also, if you had higher income this year, it will give you an opportunity to perhaps lower it and reduce your taxable income amount for this year if you expect that it won't be so high next year. It's always a judgment call, but our goal as farmers is always to even out our income across the years as much as possible. Because of our graduated tax rates, we have a situation where if you have an income spike in one year, it will cause for the same amount of income you to pay a lot more in tax than if you had had that same income spread out over 2 years, because you won't pay that higher tax rate. So again, it's always a game. It's a game of spreading out the income as evenly as possible. Another tool that we often like when it's time to sell our grain is deferred payment contracts. And that's a really great tool because it's flexible. You can sell and make the contract such that payment is not allowed until the following year. But then if it's a deferred payment contract, you also have the flexibility of electing out of that treatment when you file your tax return if it turns out that you would indeed have done better to have counted the income in 21. But a word of warning about deferred payment contracts, they're really great when used properly, but you have to follow very specific rules or they will backfire, they won't work. So if you're using those, just make sure that you check with your tax professional work with someone who can help you make sure that you're following all the rules. And again, those can be helpful tools.
Now, a few minutes ago, you mentioned the COVID payments and some other emergency payments that we've seen. How are these taxed? And can you also kind of hit on maybe the ARC and PLC payments that some of our members may have received this year?
Sure. So generally, any government program payments are going to be taxed as regular farm income, which also means that they'll generally be subject to self-employment tax as well. So we're talking generally just about regular farmers who are materially participating in the business. This year we had, well, in 2020, there were some unusual payments that came in, but even in 2021, we had some of our farmers who received what we call PPP loans. And a number of farmers received those in 21 as well as 20. And those are unique in terms of they were set up as loans, but then the loan was forgiven. But that is not income. So those forgiven loan proceeds are not reportable as income. So in that particular case, you don't have an issue with having to report that on your tax return, and you don't have to reduce the expenses either. You get to continue to take all the expenses, even if you used those loan proceeds to pay the expenses. So those were really tax favored in terms of the benefit that you would get from that payment. And ARC and PLC are just like the CFAP payments that farmers have received, just standard government program payments. So those will just show up as regular farm income, pay ordinary income tax rates on that income, and it will be subject to self-employment tax.
And now, another issue that some of our members ran into, especially with the drought conditions that we've been experiencing here in the Midwest, is crop insurance payments. How should farmers handle those crop insurance disaster payments?
Well, Corey, that's a good question because it goes right back to the principle we talked about a little while ago in terms of spreading out our income and trying to keep it as even as possible. And so, if you received the crop insurance payment in the year of the damage that occurred, if it wasn't received the following year, then the law allows you, if you would typically have marketed that grain the following year, the law allows you to defer the income tax treatment or the receipt of that income for tax purposes to the following year. So if my crop was wiped out in 21 and I typically would have sold that corn crop in 22, I would be able to defer the income from the insurance payment that I receive in 21 and not recognize that in 22. So that's just a recognition of the fact that you shouldn't be having to suffer bunched income that kind of compounds your financial woes if you suffer a disaster or receive a payment for a destroyed crop. So it's a little tool in the tax code that helps out in that situation. But again, there are specific rules that have to be followed. If you typically would have sold it in the year of receipt of the payment, you don't get to defer it. It's only there if you can show that, well, my typical practice would have been to recognize that income by selling the grain the following year. And only if you can document that are you allowed to use that special rule.
For those who can, though, I would imagine that's a good bit of flexibility that they're provided.
Yes, the tax code has a lot of nice rules to recognize the fact that farming's not easy because you have income that spikes and income that plunges. And again, it sort of can subject farmers to higher marginal tax rates than their income would otherwise trigger if they don't take advantage of the special provisions. Another really great helpful provision that everybody should be aware of, special for farmers, is income averaging. And so farm income averaging allows also a look back period if you're dealing with a particular year and you have an increase in income. There's a special provision that allows you to go backwards in time if you haven't filled up all of your marginal tax rate buckets in those years. go back and allocate some of the income backwards just to sort of even out those tax rates. It's a little complicated, but essentially it just allows you to maximize the amount of income that you can pay at the lower tax rate, as opposed to having a lot of income in the higher tax rate when you really don't over time have that much income coming in.
Are there any changes in tax reporting requirements that farmers should be aware of this year?
Well, this year we haven't had any significant changes in that area, but we did last year get a new form, 1099 NEC, which is distinct from the 1099 MIS. That was a little change that confused some people. The NEC is just non-employee compensation, so you use that form if you're paying a contractor for services in many cases, but otherwise it's not much different. Also, I do think it's important to remind farmers that they are required to file these 1099s if they pay people $600 or more. If they pay someone that much, they need to put that on record. They need to file that form. It's a requirement. And in conjunction with that, it's important that they get a copy for a contractor of a W-9, which is where the contractor gives the farmer the social security number or the EIN number. And that's important because sometimes IRS will come back to you and say, show us your W-9. And if you don't have one on file, it can cause trouble. So it's not just enough to send out the 1099. You also should be getting the W-9 as well. It's something a lot of people don't do. It usually doesn't come back to bite you, but once in a while it can, and it can result in a lot of hassle to work things out with IRS. So I would just advise to make sure to take that step.
In addition to forms, are there any rule changes in the code itself that could affect the 2021 filing?
There have been a number of additions to the tax code this year because of COVID, and some COVID relief packages and just general laws that Congress passed throughout last year, at the end of last year. And then in March of this year, there was a big American Rescue Plan Act. And so there were some specific provisions for farmers. For example, there were some changes to how net operating loss rules were reported, but most of the rules were generally applicable to all taxpayers, but they will impact farmers as well. And so we've had a situation where for half of 2021, most farmers with children have been receiving an advanced child tax credit that has been deposited directly in their bank accounts every month. And that is something that when they go to file their tax return for 21 in 2022, they will have to make sure that it gets reconciled with the amount of the child tax credit to which they're actually entitled. So there's going to be a lot more need to collect records of that, to make sure that you're working with your tax advisor so they know how much you received, etc. There was also a third round of an economic impact payment, $1,400 per person, that was paid out in 21, and that too will need to be reported. It's not reconciled in the same way in terms of if you were paid for someone that you weren't entitled to receive the payment for ultimately. For example, if you had a child age out but IRS paid you, you don't have to pay that one back. So that's a helpful one, but you still have to be able to provide to your tax preparer the amount of the payments that you received, because it does have to be reconciled. There's also been some special credits that have been available to those who have suffered COVID. So if you actually had COVID and had to miss work, were unable to work, even as a self-employed farmer, you were not able to work, or you had to care for children who were sick with COVID, or you got sick from a vaccination or had to take time off to get a vaccine, there's a special credit that even self-employed farmers can take on their tax returns to compensate them for that lost time. And essentially, every day you miss, if you're sick, you can get basically repaid for that amount of money, which is calculated based on 1/260th of your overall net income for the year. So each day missed is sort of one day's pay. So something to talk to your tax advisor about and make them aware of if you had to miss work, if you were unable to work because of COVID. There's also a helpful credit for those farmers who have employees that's called the Employee Retention Credit. And that can actually be a very helpful, beneficial credit just if you can show that your income in 2021 for any quarter was 20% less than it was in 2019. And so if any quarter your income was only 80% of that income from 2019, you are entitled to this credit, which is actually very generous. It's up to $7,000 per employee per quarter, depending on, of course, if you didn't pay them that much, it wouldn't be that much, but it's a pretty generous payment. Basically, you get to count $10,000 per quarter per employee as qualified wages, and then the credit would be 70% of that. Now, there's a lot of technical rules. It's a technical credit. You need to work with your tax advisor on it. For example, you can't use the credit for wages that you paid to your children or other certain relatives. But in some cases, you can use it to pay a spouse if you're a self-employed farmer. So again, it's a credit to ask your tax advisor about.
Well, we've gone over so much. So I guess just kind of wrapping it up here, what are some strategies right at the end of the year that our farmers could use to maybe reduce their burden for 2021?
Well, I think we just go back to some of the ideas that we talked about in terms of making sure that if there's action you can take year end to even out your income by either taking a deduction that would actually mean, we talked about the prepaying of expenses or entering into the deferred payment contracts or taking advantage of if you're going to purchase something, maybe you purchase it this year if it would be more beneficial than purchasing it next year. Again, it all is going to depend on your individual financial situation. So that's why it's so important to get those books and records in order so that you know exactly where you stand, where your income is relative to last year, and where you might project it to be for next year. So lots of activity, I know, coming out of the fields, but don't put off that important work of just making sure to clean up those books and records so that you can be ready to have those year-end tax appointments and make those decisions or take those actions that might be beneficial for you next year.
Where can farmers go for resources or to learn more on this topic?
Well, we have a number of resources on our website. We're at the Center for Agricultural Law and Taxation at Iowa State, and you can just Google search that or whatever search engine you use, or you can just type in calt.iastate.edu, and it's just a website where we try to keep a lot of helpful information about taxes and agricultural law as well. And I would like to say, Corey, I didn't mention thinking about beginning of next year. A lot of farmers, they don't pay estimates. That's pretty standard that we don't pay estimates throughout the year. And then we look to March 1st as the deadline for when you have to file your income tax return and pay your taxes. But that has become increasingly difficult throughout the last couple of years, I'd say, because we're always having last minute tax changes. IRS is not getting forms done in time, and it's really always very tough to get that tax return filed by March 1st. So I wanted to remind everyone who's a farmer of the alternative that you have, that as long as you pay 2/3 of your estimates by January 15, then you can file and pay the rest of your taxes on April 15, like everyone else. So it's something I think we're seeing more farmers take advantage of that instead of doing the March 1st deadline, which has gotten to be a very stressful endeavor as of late. And I don't anticipate it will be any different this year, given Congress looking to change some laws. So again, just a tip, talk to your tax advisor to see what they would recommend.
Well, thank you, Kristine. This has been incredibly informative, and I know our members are really going to appreciate just all these tips and tricks. And as always, I think the most important thing is be in contact with your tax preparer and be sure to keep them in the loop with what's going on with you.
Absolutely. Thanks, Corey, and good luck to everybody as you wrap up the year.
It's never easy, but Kristine has given us some important things to keep in mind as you start meeting with your tax advisors to make end-of-year purchasing plans. If you'd like to hear even more from Kristine, or ask some questions that are specific to your farm's situation, you'll want to tune in for Iowa Farm Bureau's annual Farm Income Tax webinar. That will be held on November 4th. We've included a registration link for that free webinar in the notes for this podcast episode, so you can click there to get registered. Of course, farmers and other business owners need to be really thoughtful about how they're managing their taxes, and that same rule applies to your healthcare expenses. With that in mind, next up we have Dustin Petty of BASE on how to manage your healthcare expenses in a way that will help you save on your taxes. BASE is a company that helps farmers and other business owners save money on their taxes through IRS-approved plans. They're also a Farm Bureau partner of choice, which means that Farm Bureau members receive a discount on BASE plans. That's something to keep in mind as you listen to Dustin and think about how you can keep more money in your pocket this tax season. Corey Munson has the story about BASE and how they can help farmers and small business owners discover deductions through Section 105 of the Tax Code.
So starting us off, Dustin, can you just tell us what BASE is? What do you guys do?
Yeah, we appreciate your time here today. BASE is a third-party administrator here for a variety of different plans to help out small business owners. We administer Section 105 HRA plan. We administer Section 125 cafeteria plans. We also administer the HSA plans, which are all valuable benefits to business owners. And what we do is we work with companies to try to see what the best benefit is for their situation.
Well, and I know one thing specifically we wanted to hit on was the Section 105 tax savings plan. Tell us a little bit about that.
Yeah, the Section 105 plan has actually been around for quite some time. It started in 1954, and essentially what it is a section of the IRS tax code that allows self-employed people to take a deduction for medical expenses through their business. You know, again, back in the day, it was established for farmers, and what they would do is they would hire their spouse as an employee, pay them a small wage, but then that would allow them to reimburse their employee, which is their spouse, for their family's medical expenses. So it becomes a tax-free benefit to the employee, which, for an example, would be that spouse, but then becomes a tax-deductible expense for that farmer. So then they would be able to take that as a deduction, saving the federal, the state, and the self-employment tax in reference to those expenses. So it becomes a significantly large deduction for that business owner in that situation.
Folks might be wondering why they haven't heard of this before. Is this a legitimate program offered through the IRS?
It is. It comes from IRS Tax Code 105. Like I had mentioned previously, early 2000s became that HRA that you commonly hear from now. It's something that a lot of accounting and tax professionals are aware of. And just with a lot of the changes in healthcare, it's something that's just becoming more and more popular because of the cost of healthcare. So it's definitely something that is very valuable and is looked at in the eyes of the IRS.
Now, as you know, a lot of our membership is farmers around Iowa. So given the variety of healthcare options that are available to them, why would this be a good fit for Farm Bureau members?
Yeah, it would be a great fit just because of the cost of healthcare. There's been so many changes since the Affordable Care Act with different types of health insurance, but more importantly, out-of-pocket expenses. Deductibles are continuing to increase. We see a big rise in dental and vision expenses with not only themselves as the owners of the plans, but also with dependents. Take, for an example, if a child needs braces or orthodontia appointments, those are large expenses that self-employed people face. This HRA plan gives them a great option. Obviously, they're going to be incurring this expense. This allows them to take that as a deduction. So the big thing is, obviously, premiums continue to increase, out-of-pocket expenses and deductibles continue to increase. So therefore, that HRA plan becomes an extremely valuable benefit to those small business owners.
Well, and you're absolutely right. Healthcare costs are not going down anytime soon. So this sounds like an exciting opportunity. Can you tell us a little bit more about how Farm Bureau members can sign up?
Yeah, a couple different ways to get some additional information. Obviously, you want to make sure you look at your Iowa Farm Bureau member benefit page. There's additional information when you click on all the great benefits that Iowa Farm Bureau members can receive. So your Iowa Farm Bureau member benefit page, but also baseonline.com would be able to provide some additional information there in reference to that as well. You can also reach us toll-free at 866-550-5525. We appreciate your time, and hopefully we'll hear from you and be able to answer any questions that you have.
If you're a farmer or a small business owner, I think you owe it to yourself to at least kick the tires and see if BASE makes sense for your situation. And while you're doing that, remember that Farm Bureau members receive a discount on BASE services. You can learn all about that benefit by clicking on the link that we've put in the notes for this podcast episode. And while you're down there in the podcast notes, remember to register for Iowa Farm Bureau's free farm income tax webinar on November 4th. That wraps up another packed episode of the Spokesman Speaks. I hope that you discovered a few useful tips in this episode and that you'll join us again for our next one on November 15th. Thank you for doing the work that inspires everything we do here at the Iowa Farm Bureau, and thanks for listening to the Spokesman Speaks.
Thank you for listening to the Spokesman Speaks, a podcast by Iowa Farm Bureau. Check out more podcast episodes at iowafarmbureau.com/podcast. You can also find and subscribe to the Spokesman Speaks podcast in the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, and other popular podcast apps. We appreciate your ratings and reviews, and we welcome you to email us your feedback at podcast@ifbf.org.